very much. Dear guests, dear members of the British Chamber, dear partners and guests from KPMG side, I welcome you all today. My name is Dinara Abileva and I represent British Chamber of Commerce in Kazakhstan. So please let me thank you, KPMG, for this opportunity to have this really trendy topic today. For British Chamber members and also for partners and the clients of KPMG. So today we have current issues on taxation of oil and gas companies in Kazakhstan. I think that Temirlan and Altynay will let you know about the content of the presentation later. And our speaker today is Temirlan Yementayev and Altynay Makentas, Managing Advisor of Tax and Legal Department from KPMG. So as Aida told you before, you can type your questions during our presentation, and we will have a Q&A session after the presentation of Temirlan and Altynay. So let's begin, and I'm giving floor to Temirlan. Thank you.
Thank you, Dinara. Thank you, Aida. And firstly, I want to welcome everyone for joining today's event. I'm looking forward to have an enjoyable 1.5 hours. I hope it will be useful to you. Again, let me introduce us, me and my colleague Altynay. I'm Temirlan Yementayev. I'm a tax manager at the corporate tax department in Nur-Sultan, KPMG. I've been joining KPMG in 2014, and over the past 7 years, I've been privileged to work with many oil and gas companies, operating both under the contracts of product sharing agreement and the standard, let's say called non-PSA standard contracts, so use contracts. And Altynay is a tax advisor. She will be assisting me on today's presentation, today's webinar. Today, let me briefly jump into the structure of today's webinar. So we basically have two main sections of our webinar. First is related to the taxation of subsoil users. So it will be, again, will be mostly raising questions related to the taxation under the current tax code. So it will be, we still believe it will be partially helpful even to those companies that operate under stabilized tax code, because some of the questions are universal and related more to the accounting side that creates issues of taxation. And then we'll talk about relevant current issues of taxation, not directly related to the specifics of the oil and gas, but we'll outline briefly some of the issues that are of the very high interest among the taxpayers and among tax authorities as well. At the very end, we'll just have brief look over the changes in the tax audit and the cameral control. Mostly the last part will be dedicated to the changes in the cameral control and changing the interaction between tax authorities and taxpayers in Kazakhstan. So let's start from the short and brief introduction, very short. So as you all know, we are living in a country very dependent on oil income, and consequently on our tax budget. Our budget is very dependent on the inflows of oil tax money, and the current economic trends are the following: that oil prices globally are decreasing, and even though that in the past like 4 or 5 months we see the slightly increase of the oil price, the general trend, if we look for like 5 years, past 5 years, is the following: that oil prices are going down, and therefore the declining budget revenue. There is a decrease in the budget revenue, and this is the problem that tax authorities, not tax authorities as authorized body, but generally to the government, generally the country budget, is facing that the budget inflows in the budget are declining, whereas together with that, last year you all know that this was even worsened by the situation related to the coronavirus. But for today, we will not be talking about the changes related to. We will not be talking about the government reaction with regard to taxation on coronavirus updates, but mostly we'll be specifying our attention only on the taxation of oil and gas companies and the current agenda of tax authorities. Briefly mentioned, as you all know, in December 2020 there was ratified and approved the law order on bringing new changes to the tax code, and even though this order was elaborated over 2 years, starting from 2019, it just provided a general overview that if we're talking about the subsoil users and talk about specifics of subsoil use of taxation under subsoil use contracts, no significant changes was introduced in this document. So I'm like as a tax specialist, let's say in oil and gas company, for me the taxation in most of the cases becomes unchanged, unless we're talking about like some very specific moment. But in generally, like for me, the taxation stays unchanged with respect to the recent changes to the tax code. But the current agenda, I understand that tax authorities, and for me, we have all the taxpayers and subsoil users should understand that tax authorities now becoming more aggressive because of they have to prevent declining of budget revenues. The tax authorities, like State Revenue Committee in general, they're trying to find ways to provide stable inflow to the budget, and in some ways they are becoming more aggressive with respect to the some, let's say, some tax issues which we believed already was stabilized and already were settled, but now sometimes they're changing their position. That's probably one of the reasons why we make this kind of webinars, just to provide you outline of what's going on, what happens, what risky moments are currently in taxation. And we briefly, again, talking about the current agenda of tax authorities, we cannot not to mention the changes that happens in the tax authorities in their interaction. Now we see that tax authorities shift their attention from in-person tax audits, let's say like personal control of the taxpayers, and shift it towards remote control. So they're working on efficiency of camera control. So I believe if we talk just about like 2019 and 2020, many taxpayers might notice that activity of tax notification under camera control rises. So taxpayers receive more and more notifications, and I believe that it's a future trend. I mean, the tax authorities, as they comment themselves, often during different platforms where they speak, and they always comment themselves that their long-term aim is to shift maybe fully, because I mean nowadays technical let's say infrastructure allows to shift from the personal control of the taxpayers to the remote control. So now we have to deal with lots of notification. Some of them might be incorrect, but this is what we're going to talk today. And all this together rise issues. I mean, issues of taxation is what's like major topic of our webinar. So we believe we have to divide these issues, because I mean we'll be talking about many topics. Like in this like short 1.5 hour webinar, we'll envisage. I mean, we'll include like 10 or 15 topics, every of which could be subject of separate seminar because questions are the rising questions are very sometimes uncertain, sometimes are very risky, and issues. It seems to us that this kind of issues are majorly caused by the three things. That sometimes first one is a change in position of tax authorities. It's something I talked like a minute ago. So we have, for example, change in taxations, and then we decide how we apply this, like for example, new provision of tax code. Then we settled it. It's no more problem. But then in 1-2 years, tax authorities might change their position and start triggering some sort of risks that before were before we believed is no problem. Before we believed we already resolved them, but sometimes some, let's say, permanent risk rising again, and we believe it's always becoming agenda and a hard topic for any tax specialist. Then we always have to deal with omission in tax legislations. Many of the problems are rising because tax code does not provide clear procedures or clear clear provisions for applying this certain clauses, certain articles of tax code in practice, and therefore it creates ambiguity with regard to approach. Different taxpayer has different approaches, and even the tax authorities, again, depending on region, might have different approach, and that creates just enormous amount of efforts that people bring to resolve and to clear certain tax issue, but because of different approaches and because of probably lack of communication between the tax between the not the tax specialists, but between the companies, between the business, such sort of permanent problems seems to have risen again and become more of interest of tax authorities because of the declining budget revenues. And also we will share with you some frequent technical mistakes that we as let's say that we as tax consultants, part of the big four company that both has tax consultants and audits, we face many mistakes, like just technical mistakes that are probably clear due to probably clear in terms of its provision in tax code, but however we believe some companies and often probably misinterpret or having troubles with applying these provisions in practice. So now I'll pass the word to Altynay. She will start section 1 of this webinar and start discussing about the certain problems that occurs at the companies in oil and gas. Altynay, what's your?
Thank you, Temirlan. Good afternoon, everyone. Thank you for joining us today on our webinar regarding taxation issues of companies in oil and gas sector. And I will start with the problems related to ring-fenced accounting. As you know, all income and expenses of the taxpayer are divided into direct, indirect, and general ones. Direct income and expenses are the ones that have direct causal relationships with the one contract only. General are the ones that are distributed between contract and non-contract activities. Indirect income and expenses are the ones that have relationship with several contracts at once. And the classification of income and expenses is determined by the taxpayer independently. The only condition is that they should comply with taxation principles. Recently, there was we faced a case when a company was under tax review and was checked for CIT and excess profit tax compliance. Tax authorities didn't find any inconsistencies. However, they challenged it and tried to discredit the distribution methods classification used by the company. When there are several subsoil use contracts, changes in the indicator of one distribution method can result into significant additional accruals, especially if there is a change from non-contractual to contractual activities, and additional obligation will arise immediately. And as you know, the tax authorities always try to increase income from contract activities and decrease liabilities from non-contractual activities. And as a result, it has impact not only corporate income tax, but also on excess profit tax. And this was the case when this was the first case when we faced such a situation when tax authorities challenged distribution methods. Therefore, we recommend our clients to consider the riskiness of their distribution methods. In practice, there are less risky distribution methods. For example, if a company has several contracts, it might divide all the income and expenses depending on the volume of oil produced. This coefficient is not risky because the volume of oil is determined only once, and it's hardly to disprove it or change since it is confirmed by different reports. But if a taxpayer simply uses the distribution method depending on total amount of income and expenses, this is a risky distribution method because if one type of income or expense is transferred from non-contractual to contractual activity, as a result, all coefficients will change. Generally, we recommend to avoid situations when one article of income or expense entails change in all deductions. It is less risky to have more distribution coefficients, and they should, and those distribution methods can be chosen independently by the taxpayer. The only condition it should comply with, as indicated in the tax accounting policy, and it should comply with taxation principles. In the next slide, it also applies to ring-fenced accounting, and here are some examples that subsoil users might face while maintaining accurate ring-fenced accounting. In one case, we faced the problem when significant expenses were incurred prior to the date of signing the subsoil use contract. And it created a huge problem for the company because tax authorities said that these costs were not related to contractual activity, although there is a direct connection with the contract. At the same time, they cannot be considered as non-contractual since they are not related to income received from non-contractual activities. As a result, these expenses have a high risk of being excluded totally out of deductions. Further, interest deductions. We often see that taxpayers do not consider the purpose of the loan they take. They just recognize such expenses as the general expenses. But usually the purpose of the loan is indicated directly in the contract, and each time it can be different. If it is indicated in the contract as to replenish working capital, then it will be treated as general expense. However, if the contract specifies the purpose of the loan as, for example, for the purchase of equipment related to specific contract or for the construction of a plant, then those interest deductions do not need to be divided and they can be treated as contractual. However, if a subsoil user has a large non-contractual activity and if a loan was taken directly for non-contractual activity, it is risky to treat them as general. Next issue is regarding rechargeable recoverable expenses. This is a very common practice in Kazakhstani market, and it happens when one company incurs expenses for another one, and then simply recharges those expenses, recognizes income, and accordingly takes deductions. And usually, company recognizes expenses as general and income as either contractual or non-contractual. However, in ring-fenced accounting, company needs to go for initial recognition of incurred expenses. As we said, generally, classification of expenses and incomes in contractual and non-contractual activity is it's the object of risk, and it might lead to significant additional charges. Therefore, we recommend our clients to pay high attention on classification and distribution methods of income expenses and to be consistent with the tax accounting policy.
Altynay, let me just add on your topic, but I'll specify my attention on the first point related to expenses incurred before the date of signing of sole-use contract. This is one of the certain cases that appear to be more common in the recent years. For example, we have some sort of pre-feed researches that are happened. For example, new initiative of the company, and company tries to look for maybe some new for some new initiatives for more discovery of natural resources. But before that, before even signing of the contract for discovery of oil and gas, the companies started to have some started to incur some pre-feed pre-project expenses, and that was a really big problem and big risk, because I mean, for the companies, usually if company starts working on the discovery of new natural resources, some geological and geophysical works, then it usually should be approved by the working program, by the corresponding contract for commercial contract for discovery of natural resources. But sometimes the companies, and we face like in a past year, the company incurred certain expenses like project research, which they start doing even before the signing, and bidding for the oil contract, discovery contract. And with this situation, the company faced the issue. For example, I faced the issue. I have these expenses, and I don't know whether they can be distributed as whether they can be allocated as my contractual expenses. And I do some short analysis, and I decided no, because I mean, this is my other works, is my other activity, and is more related to my new initiative, and I cannot include them into my ring fence related to my contracting activities. At the same time, tax authorities express their view. So if the tax authority position is that taxpayers cannot include those expenses even in non-contracting activities. That is because if we talk about like pre-project researches, like new initiatives, some engineering, maybe some marketing analysis, those analysis is not directly related to the future income of oil, because sometimes we have this market research or pre-feed project research just to form our bidding candidature for the discovery contract. But at certain point, taxpayer can decide to cancel this initiative, and then there is a problem with this kind of expenses, because I mean, tax authorities taking very aggressive position that such expenses at the very end up to be just non-deductible, because they classify them as expenses which will not bring any economic future in any economic income in the future, any economic benefit in the future. But therefore, for this type of cases, we always say to our clients to prepare at least defensive position under which the taxpayer can justify and substantiate why these expenses been incurred, and what are the future benefits or future plan for benefits for incurring these expenses. And of course, try to comply with other regulations like subsoil use code for justifying such kind of expenses, because they seem to be, as of current position of tax authorities, any of these kind of expenses seem to be non-deductible. But we believe every taxpayer should take attention case by case and prepare its own defensive position for justifying such expenses. Altynay, thank you.
Okay, thank you, Temirlan. Now, I would like to talk about other issues that we encounter during our tax audit. These are kind of permanent issues that we face, and the first one is the exchange rate difference. This is an issue because this topic is not fully regulated by the tax code, and it arises when tenge is not a functional currency for financial reporting purposes. There are quite a few oil companies whose functional currency for financial reporting purposes is the dollar, and in this case, taxpayers usually keep parallel records, and such parallel records create exchange rate difference. That is, one account is kept in dollars, where arises USD forex, and at the same time, another account is kept in tenge, where arises tenge forex. And companies use this second parallel accounting in tenge to calculate their tax liabilities. This is a practice that has been developed in Kazakhstan market, and all accounts receivables and payables, loans, everything is done parallelly in tenge. All dollar costs are converted into tenge. And such approach, it creates forex gains or loss. And in our economy, since dollar is growing all the time, usually in tenge accounting, the exchange rate difference is quite high. It creates tenge forex loss. And in USD accounting, which is used for financial reporting in financial statements, the exchange rate difference is smaller. Since accounting is in the functional currency, and usually it creates USD forex gains. And it has been an issue for taxpayers because it was an issue because depending on which exchange rate difference to take into account when calculating the corporate income tax, either they should use the USD forex from financial statement, or they should use the tenge forex from accounting that is kept parallel in tenge, which is kept directly for the purpose of compiling tax statements. And historically, many companies took the tenge forex, and some companies deducted it and passed tax audits, and there were no additional charges for this approach. However, recently we encountered for the first time in a case when a company receives a notification from tax authorities to adjust their forex difference according to financial statements, i.e. to use USD forex gain. And the company agreed to do this because this issue, as I said, is not settled by the tax code, and the reference goes to IFRS, and the company made a decision to pay additional corporate income tax on this USD forex gain. That is, before, during tax audits, tax authorities were not interested in financial statements. Now they might refer to financial statements, and their position might change depending on which forex, i.e. USD or KZT forex, brings more CIT.
Yeah, I believe, Altynay, let me just add on this one. I believe this is good demonstration of how tax authorities, again, in a situation in a country related by the following declining budget revenues, that they sometimes go back and reconsider their already settled tax position again, the problem is that because if you go to the tax code, and tax code says that exchange difference gains and losses should be accounted with respect to IFRS, and literal reading of this provision gives tax authorities arguments to say that if I should directly follow the rules of IFRS and I open the financial reporting of the company, and in financial reporting I see the forex gain, I just should translate it forex gain and include it in the aggregate taxable income for CIT purposes. However, it just again, it's just a literal reading of the tax code, because if you go in the substance rather than over the form of the version of the tax code, in the substance, all the Kazakh oil companies, they having their accounting records, not accounting records, but they have their payments in KZT. And for example, all the Kazakh companies, they have enormous imports from the non-residents, loans, sometimes loans from non-residents, and all that, if you just, in fact, creates additional loss of money. Because, I mean, in 2019, $1 million was much less in KZT than it's now. But if you just go directly and look from the point of view from the dollar side, it stays the same. There is no problem. I mean, there is no any forex difference. But in fact, the companies struggle to find another millions of KZT to fill this gap between these, to fill this gap caused by the exchange difference. So our position, and it's actually traditional position of taxpayers and subsoil users, that using USD functional USD forex would be in our economy, in Kazakhstan economy, when dollar overgrows in relation to tenge, would be not fair, just unfair, because it just, let's say, numerical representation. But in fact, all the companies suffer losses due to the fall of, due to the growth of the USD rate. And therefore, I mean, if a company encounters the situation in which tax authorities literally read tax code and they attempt to include in taxable income just forex gain from the financial statement, I believe the every company should defend its position for using KZT tax, KZT forex. However, again, to secure let's say safeness of this position, we believe the only possible way is to bring corresponding changes to the tax code to add clarity for this kind of situations. Okay.
Okay. Next issue is related to income from oil sales. We want to bring your attention to the fact that there are risky periods when the price of oil is extremely low, and in such cases, companies just make some technical errors by not comparing sales prices with the production cost of the oil. This is a risky issue because the tax code states that income from oil sales is determined based on the price of the sale, but not less than the production cost of the oil. We emphasize again that it is very important to compare the production cost of oil with the cost of sale. This is very important for the periods when the price of oil is low. Income from use of associated gas. Also, we came across a practice when a company in its accounting records reflected the cost of associated gas, which was used for own needs. And it is clear that they can be the cost price of gas when there is a separate well for gas. In this case, as in most subsoil companies, gas was produced as associated gas, but still the company had an accounting cost for it. There is a formula in tax code specifically used for calculation of production cost of associated gas. And we believe that in such cases, if cost reflected in accounting system is lower than the cost that is calculated by the formula, it creates risks. And tax authorities will recalculate income from use of associated gas for own needs, and there is a risk of accrual of additional charges. Next, subsequent expenditure. Next frequently discussed issue is a problem with subsequent expenses. Subsequent expenses are the expenses that contribute to the possible future economic benefits from the use of asset, and they should be added towards the asset value. Here on the slide, we refer to IAS 16.7, which does not separately consider the criteria for recognition of subsequent expenses of an asset value. There is no such concept in IAS 16 as additional capitalized expenses. The cost of assets either recognized or not recognized. The cost of an asset is recognized when it is probable that the economic benefits associated with the assets will flow to the entity, i.e. the cost of an asset is recognized when there is an economic benefit, or the useful life of an asset is extended, or the performance of an asset has been changed. So when analyzing subsequent expenses, in addition to IAS, taxpayers also should be guided by other legislations. We had a case when a company incurred a very large amount of subsequent expenses, which in accounting were recognized as current expenses and were deducted. But during the tax audit, the tax authorities disagreed with this approach of the company and said that these expenses, in fact, was capital expenditures. Tax authorities, they look more closely at such costs, and subsequent expenses is a risky article, and they need to be analyzed analyzed in detail. Here on the slide, you can see an excerpt from court decision. And in this example, company performed such works as hydrochloric acid treatment, horizon waterproofing, redevelopment, and expenses for these works were recognized as current costs. These works were treated as maintenance, not as capital repair. During the tax audit, when analyzing these works and expenses, tax authorities, along with IAS 16, applied uniform rules for the development of oil and gas fields of the Republic of Kazakhstan. And these rules define the list of works that increase the productivity and injectivity of wells. And those works, hydrochloric acid treatment performed by the company, was listed in the rules as the ones that increase the productivity of the well. And tax authorities referred to this, and court agreed with them. Then, in accordance with IAS 16, hydrochloric acid treatment increases the book value of the well, which implies future economic benefits from the use of the well. Thus, the tax authorities rightfully recognized these expenses as capital expenditure. And as a result, the court agreed with this logic, and taxpayer paid additional amount of taxes and fines. And again, we emphasize that tax authorities look very closely at such subsequent expenditures, and when analyzing subsequent expenses, in addition to IAS, taxpayers should also be guided by other legislations that are appropriate for the industry, as in this case, uniform rules for the development of oil and gas fields. Next, also frequently discussed issue is contract liability expenses. These are expenses established in the subsoil use contract. For example, it's training of Kazakhstani personnel, expenses for social sphere development, and asset retirement obligations of the company. Here we'll talk about limits, and the subsoil use contracts set limits for the expenses. However, there have been cases when, for some certain reasons, subsoil user could not fulfill contract obligation in full in current year, and in accordance with the provision of the contract, they incurred these costs in subsequent years. At the same time, subsoil users treated the entire amount of expenses incurred as deductions. There is also a working program that is a part of the subsoil use contract, and it sets limits on contract liabilities for each year. It contains a specific number. In practice, the tax authorities always look at the working program, and they compare the actual expenses incurred with the limits set in the working program. In this example, we can see that for some reasons, company didn't have enough funds in the first year to fulfill its contractual obligations and incurred them in full in second year. However, since in the tax period, company can deduct only the amount that was accrued and paid for this tax period, and the company cannot, just on the grounds that there were not enough funds to carry forward its contractual obligations and deduct them. If the company takes such amounts for deduction, the deduction will be adjusted by tax authorities. And this is an established tax practice, and this applies to training costs and all other contractual obligations. Next, Temirlan.
Altynay, thank you for passing the word. Now we'll move forward to the recent changes. I mean, it's more related to compliance, as you probably know. That starting from 2020, I mean, the form for excess profit tax, I mean, tax return form, was eliminated, and this form was integrated into the corporate income tax form 150 as the appendix 12. So in general, we believe it happened due to the simplification for checking from the tax authority side, from the camera control side of this now unified form of declaration, and it goes towards the simplification for filing EPT. And generally, if we look for the changes over the past 3 years, we see that the tax authorities, even in the new tax code, 2018 tax code, they simplified certain rules for EPT, for calculation of EPT. And now we'll move to the discussing some of the issues that are rising during the calculation of excess profit tax, both related to the maybe to the omissions in the tax form, which creates certain certain issues, results in certain uncertainties for the client, and the generally tax issues that are still relevant even in 2021. Here the form, just for we will not stop on this. I mean, just to demonstrate that if you compare the old 450 tax return form and appendix 12, you can just compare line by line, and you see that in generally the form has not undergo any changes from tax, has not any changes in its structure, and therefore the filing of this appendix 12 will be the same. And I believe that tax specialists might still feel the same still face the same problems during the filing this return as it were before. So generally, before discussing the issues, let's briefly look over the stages for calculation of EPT. As you know that EPT is a tax that accrued on the net income if amount of this net income exceeds 25% of the deduction for the purposes of EPT. And how we find the net income? To find net income, I take my gross income for EPT, which is here. I mean, I believe I can show with this point. So we take a gross income for EPT, which is income for CIT purposes, minus income from disposal of fixed assets, plus income from sale of fixed assets, minus income from value added of non-amortizable assets, and correspondingly it accounts full income from sale of such assets. And then we go to deduction for EPT purposes, and deduction for EPT purposes almost the same as for CIT purposes, but the major difference is accounting of costs related to fixed assets. So for EPT purposes, we do not account, as it was, for example, before 2018, we do not account amortization. Or I mean, before 2018, we had an option to choose account amortization as deductible expenses. Now we have to exclude this depreciation of fixed assets from deduction for CIT purposes and corresponding and G&G depreciation. And correspondingly, we have to account all the costs, costs related to purchase of goods, services, and works purchased for the construction of these fixed assets and capitalized into the fixed assets or G&G. And we have to now account them along the way of its emergence. So I mean, we account these costs in a period when they incurred, even though if, for example, we have a construction and we have 3 years of construction of the plant, and in total cost of this construction is 100. In the year 1, we incurred 30, let's say USD, 30 USD. And for the purposes of EPT, we have to deduct 30 along the way of its emergence. And that also brings certain problems that we'll discuss now. And then after you get net income, and you so for me to calculate this EPT, I just divide my net income. I find a ratio between my net income and my expenses for EPT purposes, and everything that's above 25%, all that I divide by slices prescribed by the tax code and tax them with EPT. So even though EPT seems to be very technical, very technical tax that is just technically calculated on the base of CITs. So anyways, there are certain problems that taxpayers facing now, and now we share with them. So one of the problem, just before going to the problem, you remember that starting from 2018, with the introduction of tax code, with the new tax code, there was 3 years ago some major change to the calculation of EPT. As I just mentioned before, the major change related, basically, I just said one thing. The major change related to the accounting of capital expenditures, accounting of capex. If before 2018 I had an option, I might either account deductions of fixed assets when we commence into operations as fixed assets, and I might account for amortization. That's option one. And second option, I could decide when I want. Second, I could account deduction for EPT purposes of capex along the way of its emergence. So as I just provide you example with the construction of plant. And moreover, before 2018, let's get back to the example. If, for example, I had a capex of total 3 years of construction, and total amount of total cost of the plant is 100. And in the first 2 years, I incurred like 30 and 30. So my total accumulated capex at year 2 is 60. Then I might decide to deduct it partially for EPT purposes. So I do not need, for example, to deduct all 60 for EPT purposes to reduce EPT to 0, and I might decide to deduct only like 30 out of 60. So remaining 30 of my plant cost will be carried towards next years, and then I may again, let's say I might play with deduction and just to distribute in accordance of my own needs the expenses. Now, starting from 2017, tax authority, tax policy with regard to EPT changed, and now EPT, such expenses, capex, taxpayers cannot anymore decide the period in which they deduct capital expenditure for purpose of EPT, and they have to deduct it in a period, just as I said, when they incurred. And with this transition to new rules, there was a problem. There was an issue with regarding to the accumulated expenditures which were not utilized before 2018. So if, for example, when you calculate EPT for 2018, you had accumulated expenditure of accumulated capex of 100, and you did not utilize it, tax authorities provide an article for one-time deduction of cost capitalized before 2018. So if you have this unutilized capex for EPT purposes for 2018, you had to deduct it one time, the whole amount. And if you go to the literal reading of this article, you see that deduction was allowed only for costs capitalized before 2018 cost, not for the expenses. And therefore, there was an issue with regard to the tax losses, because if the company started 2018 with accumulated tax losses, which are also expenses in its substance, because losses are actually that exceeding amount of expenses over the income, and also fairly should be deductible for EPT purposes. But in 2018, according to the position of tax authorities, and this position was already settled, even though it's unfair, but the position is the following: that for 2018 you can deduct only accumulated amount of capex, unutilized capex. However, if you have accumulated amount of tax loss which carried for the CIT purposes, for EPT purposes, you just lose them. It disappears. And I believe that might be an issue for many of the companies at that time, for example, at calculating EPT for 2018. And the second, I would say, the second problem with respect to EPT is lack of procedure for adjustments. For example, one of the recent cases we had, let's think about the construction in progress again. Let's go to the capex. We have, for example, construction in progress. We are building a plant or building any fixed asset for the purpose of, let's say, extension of our project. And at certain time, we decide to cancel this project. And cancellation of the project, you all know, in 2020 was a very often case, cancellation of the projects. And you decide, for example, to sell this asset. So you constructed in 2018, 2019, and in 2020 you decide to sell it. So for this reason, tax code creates problems because it lacks procedure for adjustment of such capital expenditures. Because if you sell this asset, in here I mentioned Altynay. Now we go back to the ring fence accounting. These assets no more can be recognized as your contractual asset, and therefore you cannot anymore account them for your EPT deduction. But you have already used these deductions in 2018 and 2019. So in 2020 you have that dilemma. In which year you should adjust your deductible expenses. So tax authorities, we believe, and this already was expressed one by the tax authorities, they go out of the general rule. So you have right to capitalize your to deduct your capital expenditures only if they are related to the construction of fixed assets for the contracting activities. So if it's no more becoming contracting activities, this general rule is not anymore compliant after 3 years, and they say that you have to go back to 2018 and adjust your 2018 EPT. Then you have to go back to 2019, adjust your 2019 EPT, and it all ends up in additional fines, not fines, but I mean penalties with regard to EPT. However, we believe this approach is unfair, but it demonstrates the problems that tax, as of now, the tax code needs to have more clear procedure for adjustment, because if we, for example, draw a line between the EPT and VAT, in VAT, if you, for example, use your asset for the purpose of your taxable turnover, VATable turnover, and then in 3 years you not use it anymore in the proper way, let's say, or you sold it, then you have to do adjustment in the period when this situation occurred. While for the EPT, it's still becoming a problem, and I believe that there is, for example, a solution for this. You can just calculate your economic effect and make an adjustment in a period which brings more to, which results in more additional EPT, and that is the position of tax authorities, we believe, because this position is less favorable to the taxpayer. However, the problem is still relevant, and in this case, if you face this kind of situation, I believe you might, because of 2020, you have to think double to prepare your arguments for your decision. I'm sorry, I'm seeing in the chat that probably that audience cannot hear me. Is it still relevant? Could you confirm whether you can hear me now by tapping plus or anything? Okay, it's good. Yes. Thank you. Thank you. Then probably I'll move forward if there is no more technical issues. Okay. Now we just briefly look over, because of time limits, we'll look over some issues related to mining extract tax. One of the interesting cases we faced last year is related to determination of physical volume of oil. During our tax review and during the distribution during our tax review and during the tax audits by the tax authorities, we always, when try to check physical volume for met purposes, we look for the report on compliance of the contractual liability. Outside of Russian, we'll look for the LQ report. And now recently we faced a situation when, and that was a practice for tax authorities as well. But however, in the previous year, we found we faced new approach of the tax authorities. Tax authorities started to using other available reports of the authorized bodies and start to compare it for the purposes of taxation. And for one taxpayer in Kazakhstan, the tax authorities refer to the report of the Information and Analytical Center for Oil and Gas, which also another authorized body for which subsoil users send their reports on their oil extract volumes. And there was discrepancy between these two reports, and the tax authorities used the one which had a higher volume of extracted minerals for the period. And the problem might be for the people that the court, the taxpayer appealed against this approach of the tax authorities, but however the court decision was to confirm that tax authorities were legal in their approach, and the court provided the Article 139.2, which say that tax authorities might seek advice from an independent professional. However, even though this authorized body is not clearly an independent professional, that might be an issue for the further appeal. But if this authorized body also is responsible for accounting of extracted volumes, and therefore I mean their report also has a force. And in this situation, we only can recommend any tax specialist at our companies, at oil and gas companies, to check whether there are any other reports apart from those which they use, which been submitted to the government, and find whether there are any discrepancies between those reports. And we believe these discrepancies are arising mostly because of frequency in which submission is done. So to this Information and Analytical Center, oil and gas companies report their volumes on monthly basis, and to the Geological Committee, this report on completion of contracting liabilities is reported on a quarterly basis. And if these discrepancies actually arise and tax specialists actually not identify the discrepancies, further actions actually should be taken. But for now, we believe if court supports tax authorities in their initiative to use other reports, we believe it might be the problem for the taxpayers in Kazakhstan, because we think, our opinion, that tax authorities will be always using that one report which demonstrates the higher volumes of extraction, and therefore contributes to the additional mining extract tax. Sorry, actually it took longer than we expected. And then briefly over the mine method and technological oil losses. I mean, so this is not uncertainty in a tax code. Actually, tax code provides clear provision with regard to the taxation of MIT with respect to classification. However, we see that often taxpayers make the same mistake. They account technological oil losses, and they account them in the way they account other crude oil which is which been extracted. For example, if I taxpayer and I extracted 100 tons of oil, and all of that oil are sold on the domestic market, then, as you know, when you sell your crude oil on the domestic market, you can apply your reduced coefficient. So you can reduce your MIT rate by 2. So reduce coefficient 0.5. And there was a taxpayer whose only way of distribution of oil, further utilization of oil, was sale on the domestic market. And therefore, that taxpayer accounted technological losses in the same manner. So if my oil goes to the domestic market, my technological oil losses should be treated the same, because again, we understand the logic of this taxpayer, because I mean it's fair. So none of my oil goes to, for example, to an export to export to another countries, because 100% of my extracted oil we sell on domestic market, and therefore technological losses was accounted in the same manner as the other oil. However, tax authorities are very consistent on this position, and tax code not directly but imperatively implies that anything that is not classified in a tax in a corresponding articles should be taxed at the highest rate. And in the tax code, there is only 4 classification of oil. One is for export and for realization outside of Kazakhstan, and that crude oil should be accounted on the worldwide market price. And then there is a oil used for own purposes, crude oil sold on the domestic market, and crude oil sent to the refinery plant. And for other 3, we use reduction coefficient of 0.5, so we reduce our rate by 2. However, if you utilize your oil in a way that is not prescribed in the first 4 in the first 4 articles, you should apply the highest rate, and that is something we just probably want to warn all our taxpayers and all of our audience again. And the same goes with the water losses. I mean, the water loss. I mean, the logic is the same logic is applied here. Many companies have. I mean, when you use your water for different purposes, you calculate your MIT on the water differently, and there is a list of options which you can apply reduced rate if you, for example, use it for the purposes of production. And there is other like 7, 8 points for which you can use different tax rate. And if you use your water in the other way, not in the way prescribed in the first 8 cases, then you have to use the highest rate. And water losses, any technological losses of water during extraction, again, it should be taxed at the highest rate. And it seems that taxpayers often make mistakes on applying reduced rate for the technological loss of water. And recently, we noticed highest activity of tax authorities with regard to reduction coefficient in general on the method used on water. So again, as I just said, there is a type of utilization of water for which you can use the reduced coefficient. However, if you use the reduced coefficient, you should be prepared to justify it documentally. And in the past year, we believe tax authorities became very aggressive with regard to the documental substantiation of the reduced tax rate, and many companies appeared to have not enough documental substantiation, for example, of using water for production purposes. We believe it might be caused by the water meters, not enough water meters on every section of the production. But however, if you, again, as a tax specialist, absence of enough evidence for usage of water, for example, for production activities, to apply a reduced rate, this absence of evident reports might be the problem, because tax authorities, again, if you cannot prove that you used it for production activities, they attempt to assess additional tax and tax the water on the highest rate. And now we go briefly to some other issues that are not specifically related to taxation of subsoil users, but are also actual, and we believe are running out of time, so we go briefly through it. Altynay, I pass word to you.
Thank you, Temirlan. One of the recent issues that we encountered were about recognizing transactions as invalid with reference to methodical recommendations. Those recommendations were supposed to be an internal document of tax authorities. However, they were publicized in the internet, and there was a heated debate on this issue. Then there was a working group to finalize these recommendations. However, as of now, they're still validated. Although those recommendations are not accepted, tax authorities identify invalid transactions based on these recommendations, and such transactions are very subjectively determined by tax inspectors. The issue is that in their judgment, for the recognition of transaction as invalid, tax authorities use their own reasons, and they can make subjective opinions as that the company doesn't have enough employees to perform works or services, that the company doesn't have necessary resources for storing or transporting goods, and other similar arguments. And based on such reasons, tax authorities might conclude that the transaction is invalid. We analyzed several court decisions on this topic, and based on our analysis, we can conclude that requests of the tax authorities mostly are not satisfied by the court because, as was mentioned, tax authorities present very subjective reasons, and they usually do not consider any additional documents that prove the completion of transaction. And their claims are based on these subjective criteria from the recommendations. This was one of recent issues that tax authorities are trying to recognize large amount of transactions as invalid. Next is one of the permanent issues that we raise and encounter quite often when to recognize income and expenses period for the purposes of CIT. Namely, the recognition period of income and expenses when they occur in December-January period. That is, the expense were accrued and incurred in December, and the act of completion is dated as of January, and when to recognize such expense. In 2018, in the tax code, in Article 242, there appeared a reference to IFRS, that is, including the date of recognition, expenses are recognized in accordance with IFRS. And it seemed that the problem was solved, and now it is not necessary to look at the date of act of completion, and we should recognize expenses at the moment we accrue and incur them, that is in December. However, we faced a situation back then where the company had a lot of accruals in December, and in accordance with that new Article 242, since the company recognized expenses in accounting and with reference to IFRS, it seems that the company can recognize expenses in tax accounting too in December. However, since the amount was very substantial, we wrote a clarification letter to the tax authorities. And tax authorities directly answered that if there are no primary documents, no act of completion, and in December company didn't have them, then it is necessary to recognize expenses in accordance with the primary documents, that is in January. And this problem has not yet been resolved because there are articles that conflict with each other, and the risk will not be eliminated since the problem is not settled by the tax code. Temirlan, I pass the word to you.
And thank you, Altynay. And due to the time limits, one of the last issues we want to address in today's webinar is interest-free repayable loans. I believe many of you have already faced this situation. For example, when you have the related party and it provided related party, I mean both Kazakh parties. So non-transfer pricing legislation is applicable. You have to Kazakh parties, and one of the party provides interest-free loan to another party, and tax authorities tries to assess additional CIT on the economy on the interest-free loan. And this is probably very old, actually very old issue, and it seemed that it was already settled before. However, recently we noticed that tax authorities again started to attempting to assess an additional CIT on this economy. However, tax authorities actually provide many different positions with regard to that. In one case, they say that there is a constructive dividends, which is economy on. There is a definition of dividends, which includes also economy of on price of goods, services, and works with regard to the market price. So they try to apply this provision because and try to calculate this economy and include it in the taxable income. Some tax inspectors go another way. They go that the interest-free loan represents service provided free of charge, and goes to the articles of the tax code, which regulates procedure for determination this price of the service provided free of charge. However, until the very recently, court did not support tax authorities on their attempts to include this taxable income, but we believe, on one of the very recent cases, when we remember that when we noticed the tax court actually supported tax authorities with that provide argument that if the interest-free loan provided was represents services provided free of charge, then the Article 96.3 said that cost of property or works and services is determined according with accounting data and IFRS, and tax authorities found that this economy was actually economy on free of charge loan was actually calculated for the purposes of financial reporting, and tax authorities argued that this economy should actually be included in taxable income, and there was one court decision that supported this position of tax authorities, and we believe that is a very bad precedent, because if there was one decision of court that support tax authorities, we believe that might be this question might arise again and bring back some of the tax risk related to interest-free repayable loans that we believe that already were settled in the past. But we will provide you the copy of this presentation, and you can get acquainted with the full position of the tax authorities and decision of the courts. You can dig deeply inside this case and to make your own to form your own opinion with regard to this situation. And one of the important changes to the tax legislation starting from 2021 is the fact that tax authorities, it has been changed the definition of dividends, which are exempt from taxation with VHT. So this case relates only to paying dividends to the non-resident. And before, all the dividends that were paid to the non-residents were exempt from withholding tax in case certain condition of the tax code were met. For example, 3 years of obtaining the shares in the company or stocks of the companies. However, now there was introduced a new change that slightly changed definition of these dividends. So for now, the taxpayers can exempt only dividends in amount of previously taxed income. I mean, in amount of the income that was previously taxed with the corporate income tax. So, for example, you have 100 income and you have 50 deductions. You have 50 taxable income. You tax it with the CIT, and you have net income of 40. But sometimes, like you might taxpayers face now the situation in which if you pay dividends for several years, it's hard to justify that this distributed income which is paid as dividend was already taxed in past years. Or for example, there might be cases where dividends are paid on non-taxable income. So for example, if I have again 100 income and 50 deductions, but I have also 100 of non-taxable income. For example, it's a dividend of my subsidiary, which is paid, which is another Kazakh entity, which paid to me 100 dividends, and I'm not taxing I'm not taxing these dividends with the tax code. So for these reasons, my net income would be for financial reporting 150. If I distribute all this 150, only part that is taxed with corporate tax, which is 50, is allowed to be exempt from the taxation of VHT. The rest of that will be actually taxed with VHT as of 2021. However, the situation is worsened by the fact that tax authorities try to apply these changes to the previous years. And now we face many of our clients receiving notification with regard to taxation of dividends for the previous 5 years or 3 years, depending on the statute of limitation for the company. And for those periods, tax authorities question the correctness of application exemption. And with regard to that, we just want to let you know that yesterday there was a official position by the National Chamber of Entrepreneurs and the Ministry of Energy jointly position with regard to the application of these new rules for the previous years is not legal. For this reason, if you have this kind of notification with regard to taxation of dividends for the past years, you should defend your own position for correctness of exemption of the full amount. And defend your right for the correct application of the provision of the tax code. And I believe as of now we have several slides left, by the way, related to the camera control, and I just for the last 5 minutes, I will share you with the last section of this presentation, and now stay only on sharing with you some statistics on the camera control, and we believe that might be interesting to you. As we said in the very beginning, that now tax authorities mostly interact with taxpayers through the camera control. And we're seeing that rate of the notification for example, for 2019 has increased drastically. So now many taxpayers sometimes receive notification on the monthly basis, And here are some statistics for you. So for 2019, and this is official statistic provided by the State Revenue Committee, and it will be interesting for you just to make your own conclusions. So number of total notification for 2019 is 280,000, and only 18% of them are notifications sent to the medium and large businesses. So most of the 8 out of 10 notification are actually sent to the small businesses. Therefore, only this part, 18%, is mostly area of our interest and area of interest for companies operating in oil and gas companies, operating in oil and gas sector. And here is statistics on success for these notifications. In particular, in 2019, there was elimination of tax violations in the amount of 1.8 trillion tenge. For example, it's about 15% of national state budget. So you can see that this notification actually very effective for tax authorities, and as they say, it's now becoming much more effective than statutory tax audits, on-site tax audits, which was let's say previous practice. And tax authorities now shift from these planned tax audits towards pointing on the towards elaborating on this notification. So for example, there was a notification previously sent, and this notification was a failed because taxpayer has not replied on this notification, or has not done the actions prescribed by the notification. Then tax authorities might now they decide to make topical audits to emphasize their attention only on this one single problem, and this contributes more to the effectiveness of tax control. Also, you can see that 27% of the notification was executed by the way of just sending your clarification, and that actually demonstrates that 3 out of 10 notification are actually let's say they're wrong. If tax authorities send you a notification of the camera of control and you send a clarification and tax authority accepts, so that means that this notification was not correct, and the rate of this incorrect notification is still very high, because it's every 3 out of 10 it's just incorrect notification. And that also it also demonstrates that if taxpayer receives notification, you have to look deeply inside, elaborate it, and probably there is no problem. Probably it's just some errors of the algorithms that is integrated into the camera control, which is responsible for sending, identifying these mistakes and sending notifications. Also, number of notifications by type of tax. So 26% only of the notification related to taxes other than CIT, VAT, or ITT. So 3 out of 4 notifications related to this biggest, let's say, 3 common taxes, taking apart the subsoil users. I mean, for the most common taxpayers, this is the biggest taxes, and it contributes to the 74% of total notifications. So most of the problems with the camera controls raising only with respect to these 3 single taxes. And last but not least is statistics on the complaints, statistics on the appeals. As you remember in the previous slides, there was total amount of notifications 280,000, but in 2019 there was only 897 complaints received with respect to those notifications. So let's say only 1 out of 300 notifications was actually only in 1 out of 300 cases the taxpayer actually decided to appeal against. And from those only 262 appeals were addressed to the court, and out of them there is only 12 appeals that in which court supported the taxpayer. So you can now see that generally, if you have 300,000 of notification in only 12 court decision in favor of taxpayer, that probably not enough probably not enough efforts done with respect to the appealing and with respect to appealing against those notifications and defending rights of the taxpayers for the proper application of tax code. I beg your pardon for the last part of this presentation, which was very quick, but now the presentation, the webinar part is over, and if you have questions, we might discuss it. Thank you.
Temirlan, thank you very much, and Altynay, thank you very much for so informative presentation today. A lot of information, I think, that our guest today got today. So dear guests, if you have any questions now to Temirlan and Altynay, please type your questions in question sector. For now, I don't see any questions from you. And there was a question regarding materials. I think that, yeah, so I think that materials will be sent to all participants later when we'll receive them from KPMG side. So
sure.
Yeah, I think that it will be possible. If you have any concrete questions to Temirlan and Altynay, please type your questions now, and we can wait. I think that for a second.
Mm-hmm. It seems that there is no question from the part of the audience. For this reason, I propose to conclude this presentation by saying thank you everyone for joining today's event, and thank you Dinara and British Chamber for giving opportunity for making this joint event of KPMG and British Chamber. I hope this presentation and this webinar was informative to you. I know that we tried to include as much cases as it was possible, just to give you a brief overview for the current issues on taxations. As I previously said, every of this issue might be subject of separate presentation, but we are looking forward for new this kind of events and look forward to see you again.
That when we share materials with participants, there will be your contacts and Altynay. So if participants will have any additional questions in the future, so I think that they can address these questions to KPMG specialists.
Thank you.
So yeah, thank you very much to all of you. And if you have any questions, so please email us to the British Chamber or to KPMG. We will try to answer as soon as possible. Thank you very much to all. Thank you. Goodbye.
Goodbye.
Thank you.